you focus on deep tech. Can you explain a little bit more what that is?
Deep tech is a term that I think more describes a temporary state for a lot of technologies when they're very early. So when they're just leaving the lab, they're coming out into the world, and it could be quantum, it could be new therapies, we could be talking about new energy storage sources, all sorts of hardware, software, combination of things. If that technology finds a meaningful root in society and our lives, then it starts to mainstream, and I would no longer call it deep tech.
Can you share a story with us about a company that you've invested in that is solving a big problem for women?
You can have very different, exciting solutions for problems that women have that are entirely different for different groups of women. Endometriosis is an example of this, and we have a company in our portfolio called Gesinta that's developed a novel therapeutic approach that can reduce inflammation, and it's so rare. So it's phenomenal to see solutions like this that don't take that status quo for granted, that dig deeper into health issues that women have and really study them and come up with clinical interventions for them.
Hello and welcome to the Investing Another Story podcast. I'm Margarita Tr, your host and founder of Finance Latte, a leading investing education company. The information provided on this podcast is for your informational purposes only and should not be considered investment advice. Stay tuned at the end of this episode for more important disclosures. This is a special episode because for the first time in this podcast, we are filming in person in central Stockholm. Our guest today is Mala Valroy. Mala is a venture capitalist at Industrifonden and invests in deep tech startups. She's passionate about human-centric innovations that can create a more sustainable and inclusive society. Over the last decade, Mala has built a strong foundation in multiple technologies as a scientist and held senior leadership roles in Fortune 500 companies, including as head of Ericsson One, scaling innovations in emerging markets. As a founder, operator, and board member, she has worked with and advised startups in edtech, adtech, spatial computing, AR, VR, MR. Mala holds a Master of Science in General Management from the Stockholm School of Economics, as well as a Master's of Science degree in Biochemistry from Dartmouth College. Mala, what an impressive career, and a warm welcome to this podcast.
Thank you so much for having me, and what an honor to be the first one live here in Stockholm. That's really great.
It's so exciting to have that in-person chemistry, so I'm really excited about our conversation. So let's get started. You first started in academia, and you did your degree in biochemistry before you transitioned to venture capital. I think that journey is fascinating. Can you tell us a little bit more about it?
It's actually a long, winding road. And I think I'm better for it. Like you said, came from the academia side of it. And it was actually perfect as far as everyone in the family was concerned. I went directly into the PhD program after my undergraduate. I was doing science that I loved. It was cancer immunology, so I had a lot of purpose. And you're working with things that are really cutting, if not bleeding edge technology. But I realized that I like building things and working with people, and my need for a feedback loop was much shorter cycles than what I was experiencing in the lab. And that journey has taken me out of the lab into business school. I started my own startup. I've worked in very large companies, and then now switched over to the investment side.
Wonderful. That is a big change.
Yeah.
And I'm sure that wasn't easy, but I really admire that you didn't consider the sunk costs, so to speak, right?
I did.
You did.
I think that was so overwhelming, and I think that first time that you think about it, it feels just insurmountable. And I think that's why it took me so long that first time to differentiate between quitting and losing. I hate losing. And I think I pushed through and stayed longer than I knew I wanted to. I think it wasn't a waste, but it was certainly weighed down by the fear of change and the weight of starting fresh. The thing is, once you've done that once and you realize it's much scarier before you make the leap than when you're in that transition and when you've landed and suddenly you've landed on your feet and now there's no going back. You've just proved to yourself you're able to do this. And I think that's what's been making it possible for me to make these changes in industries, so leaving life science. The companies that I've been in have been incredibly different. They've dealt with heavy machinery and equipment, they've dealt with telco, and it's because of those things, the permission to reinvent yourself it comes at the mental cost of saying, all right, well, I'm going to have to be a beginner in something. I'm going to have to prove myself again. I'm going to have to feel that nervousness again. And I'm going to have to do a lot of explaining to a lot of people why I belong in this space and not that other pigeonhole where you think I belong. But it's worth it in the end. And I'm very happy for it.
I very much admire too, because I've also been changing a lot of things and a lot of verticals, so to speak. And it's that fear and that willingness, as you said, to be a beginner at something and to start over. And after a point in your career where you've excelled at for so long, to be able to do that, I think it's quite hard but rewarding.
I say this to my kids. Bravery is not the absence of fear. And I'm terrified the entire time I'm making the change, but it's so rewarding. And after a while, you're just in it and you forgot that you were ever doubting yourself. So
wonderful. So you are a venture capitalist. Can you give a sneak peek behind the curtain? What does that mean? What do you do day to day?
So venture capital teams are very small teams. And there's somewhat of a division of labor in the teams between people who are more analytical and support with, let's say, the number crunching and digging into the case. But my day with the investment team, it's very diverse. So I could be out listening to pitches or meeting companies. That's called deal sourcing. You often meet with other potential venture capitalists or other investors because you're going to co-invest. You're building a lot of relationships. You're making a lot of introductions. You're getting to know. When you find companies that you like, part of my day is also getting to know them better. So I spend a lot of time with the teams, getting under the hood of their products, understanding the science or the team or the plans. And then we put together our own analysis. So when I meet them, there's also an analytical part. I guess that's where the scientist in me really goes into full number crunching mode, understanding if the big picture that's being presented holds, what does that represent for an investment opportunity and investment risk. And that also then helps shape whether we come in with an investment, what size of the investment, how that journey is going to look, because you think several investments ahead. It's not just that first check you're writing. So all of that is kind of putting the deal together. And then when everybody's happy with that, there's a lot of negotiation to actually bring the deal into a formal investment form, which is very different from all the relationship building and the community building aspects of it. And then after you've done all the structuring of the deal, there's also the work together with the company. So we are on the boards and we tend to work very tightly with the teams. So there's the capital side, but there's also helping from a strategic perspective and understanding where you can help them strengthen their approach. Sometimes you can help them with other portfolio companies that you have so they can learn from each other. Sometimes it can be from our own networks or experience. It's a very multifaceted job, and I think that's really honestly why I'm so thrilled by it. I think it would be, given my track record, hard to sit in something that was defined to specific tasks that were just repetitive. It's very fantastic to have that mental whiplash. You meet a quantum company in the morning, a life science company in the afternoon, an energy company before dinner. It's brilliant.
Sounds very intellectually stimulating.
It is.
And how early stage are these companies? Are we talking about an idea on a napkin or a little later on?
If you have an idea on a napkin, don't look for VC funding. Although I think there are early stage VCs. So VCs tend to scope themselves into different phases. And I think it's very important to find one that right sized for you. We invest in what is called seed and series A. So not a napkin sketch, but you've had some time to prototype, some time to put it in front of your intended audience or early adopters. You're starting to understand what the next shape of your product should look like, but it's too early for you to have full-blown business and revenues and a proper team. So somewhat early phase, I'd say.
And as I mentioned in your bio, you focus on deep tech. I'm thinking quantum computing, but I think there's a lot more to it. Can you elaborate?
I don't think you're wrong. We are in a time right now where we're seeing a lot of intersection of different kind of technologies. So on the compute side, incredible things that we look at, which are early, coming out of science or research. Deep tech is a term that I think more describes a temporary state for a lot of technologies when they're very early. So when they're just leaving the lab, they're coming out into the world, and it could be quantum, it could be new therapies, we could be talking about new energy storage sources, all sorts of hardware, software combination of things. If that technology finds a meaningful root in society and our lives, then it starts to mainstream, and I would no longer call it deep tech. So for us, we're looking at technologies that have a clear scientific foundation, that have an early start. So they have to build a product and a market at the same time right now. And it's very broad in terms of verticals, but we are taking an enormous technology risk as well as a commercial risk when you invest in deep tech. And some examples of this, if you want to go really, really early, of course, it's things like fusion, it's like quantum computing. And these are things that are actually further along than maybe the average person knows about it, but it's built off of 60, 70 years of science that has now finally become mature. If you look further down, we are now living in a more and more connected world. There was a time when IoT was completely novel. Having connected things was novel, and now it's kind of taken for granted that it is. But it's still emerging. It's still early. There's a lot of therapies that are coming out, new approaches that are early, and also then deep tech. Examples like we can make mini 3D models of organs to better cure human diseases because it's impossible to cure them. We can succeed with mice and then fail in humans. And here we're taking the burden off of human patients with the testing with these kinds of models. So a lot of fascinating developments. The electrification that's happening all around you, that's also driven by deep tech. That's emerging science on what's inside the batteries, how quickly we can charge them, how long we can keep them charged, and how we can integrate them seamlessly into your life, whether it's the roads, the cars, or all the other modes of transport that you have. So you are touched by deep tech all around you. It's just not known that it's mainstream yet.
That is so fascinating. And thank you so much for giving us the extra color on everything that is around us that is deep tech. And how many pitch decks do you review per year, if you do count them? And what percentage of those companies do you invest in?
So I think this is a tough one because on one hand, we look at an enormous amount of pitches, and that's absolutely true. But in VC, you rarely go out and just scavenge for deals. You're very intentional about it because your fund has a certain thesis. You're either investing in a certain geography, certain sectors, like I mentioned, or certain stages. So you're already sort of narrowing down the field. And within the teams, you tend to have your relationships and your interests, right? So we're quite thesis driven. And so that means that we almost pre-formulate our vision for the kinds of science or the kinds of pain points that we want to find solutions to and we want to invest in. So when I'm out, I'm looking for certain types of startups, and very quickly I can assess whether this is the right fit for a pursued conversation. So that does narrow down from the total amount of potential pitch decks you could be listening to. But that said, there's a lot of first conversations and very, very few following up conversations because it's a matchmaking.
And are we talking hundreds of first conversations, maybe thousands a year?
I think over the course of a year, we're easily looking at hundreds. Yeah. You can easily look at more pitches, but sometimes pitches are sent to you. Sometimes you've gotten a company recommended to you. These are called warm intros. And sometimes you stumble upon them serendipitously because you're out at a conference or at a presentation. But we're often very well aware of what is out in the ecosystem well before sometimes even it's formed a company. We follow companies before we are ready to invest in them to be able to follow their progress. So in that sense, it's not just what I want to invest in now that I'm reviewing. I'm looking at pitch decks that I hope to in 2 years' time, 3 years' time, maybe invest in and see how it goes.
And how many investments do you do per year, more or less?
2 years ago, when our team was new, we did 13 new investments from our fund. Last year, I think it was 6, which is a high number for a fund, but around there is usually what you'll see. So investments.
Select few, in other words.
My first year I did around 2 investments, and then it's roughly around 2 to 3 investments a year per investor. Some people are more active, but that's usually around how many investments you can do meaningfully.
Wonderful color, thank you. Can you give us an example of an investment you made where you were quite early on, and just give us a little bit of the thought process of what your analysis looked like at that early stage?
Mm-hmm. I can actually give you one from when I did an angel investment, which I've been able to follow longer because you come in so early, which is rare for me. An app. I tend to go in quite deep, as you see, in very technical things, but this really captured my heart. I had just had my kids, and you know what it's like when they're young and you're just so invested in their sleep and everything else. And I had these apps that I was trying to use. I think our generation just leans towards wanting tools for being a better parent and making life easier. And I had set up this 4 different profiles for my kids in order to find the average of when they were sleeping and whatnot. And a company reached out to me and said, hey, we're a team of parents. We've built this tool because we're so tired of what we're seeing. And something about just the earnestness and the clarity of it booked that first meeting. We started talking, and it was so clear that they had gone above and beyond just solving a problem when I met them. In that very first meeting, one, you could see so clearly their passion for this. It was so beautiful to see how they imagined the product and how parents, tired parents, would be interacting with it. I don't know if you've ever used one of these sleep apps before, but you have to sit there and you're already sleep deprived and you're supposed to put in all this information about you, and you can barely keep your head on straight. And they had already been thinking about these things where it's like, you come in, it's effortless, it's easy, and we don't just care about whether your baby's sleeping, we're caring whether the family is feeling okay. And so all of that just hooked me in, and they had a very early product, so to speak, at that point. But I could really tell from that relationship and the communication that, yes, I was in love with the product, but I was very enamored with the team and how easy it was to talk to them, how willing they were to reach out for help when they needed it, how resilient they seemed in the face of a lot of challenges. And they have proved that time and time again. And it's one of the investments I'm most proud of because they have overcome everything you could ever imagine, personal, professional, product, bugs, with a smile on their face. They've been vulnerable about when they needed help. They've reached out to me. We've had countless coffees. We've grown very close in terms of more than I think just investments. I care about the company, and that's because of them. I think it's a hallmark to them that they can build something that you fall in love with. And that's what we see also from the customer side of it. The testimonies we're seeing are not just, this product is great to use. People are really going out and sharing it with their friends and recommending it and talking about how the art makes them feel and how the music makes them feel and how the app makes them feel. So I think there is something special about building with your whole heart. We know some things, we're really good at these things, and we need your help for other things. So the company has been, every single email update I get as an angel investor has a new sales record that they've broken. It always has a clear ask or transparency around what broke. I find that wonderful. I always feel so comfortable about my investment. I know that they're going to tell me when it's not okay. So it's not just here's something shiny. And I've just seen them steadily grow. They've grown in number of teams. They've grown in number of markets. Like I said, their sales is doing amazing. Apple called them the app of the day.
And what is their name?
Napper.
Napper.
Yeah.
Okay.
They're just brilliant.
Wonderful. And I love what you said about, first, that you understood the product, you had that pain point and they solved it for you. The team, of course, the brilliance behind the team, but also the emotional connection. I think that's really hard sometimes with the startups. They could have an amazing product and team, but the emotional connection with the client is not there.
The resonance is really important.
Wonderful. Great example. So can you share a story with us about a company that you've invested in that is solving a big problem for women and that you're really excited to see that company grow?
I can actually give you several, which is so fantastic. And I just want to temper my answer by saying that I think saying that there are solutions for women is such a blanket term, and it's, treating women like a monolith. You can have very different, exciting solutions for problems that women have that are entirely different for different groups of women based on where they are in their lives, where they are in their financial stability, where they are in their health. So with that kind of spectrum in mind, I've seen really exciting stuff happening when it comes to financial literacy and financial independence for a lot of young women who are new. They don't come from, let's say, the big cities where, a lot of the opportunities that we think are just taken for granted are less available. And so there's been an enormous momentum around how you can have alternatives to financing, especially if you're new to a country, if you're in countries or regions where banking is not as common. This is in large parts of Asia, in Latin America, in Africa, and there are financial models that are being built for more financial inclusion, which I think is brilliant to see. And it's been spurring entrepreneurship, it's been spurring education, it's been spurring a lot of fantastic growth. So there's those kinds of solutions. There's health aspects which are understudied, and it's known to be understudied. Endometriosis is an example of this, and we have a company in our portfolio called Gesinta that's developed a novel therapeutic approach that can reduce inflammation, and it's so rare. If you have endometriosis, the standard of care right now is just to give you birth control pills. And when you interview doctors or experts, they'll just say, yes, we've been solving it with birth control pills and the women are happy. And I can tell you, after having talked to many women who have it and friends who have it, the women are not happy. They've just given up that there is another solution. So it's phenomenal to see solutions like this that don't take that status quo for granted, that dig deeper into health issues that women have and really study them and come up with clinical interventions for them. There are also startups that are revisiting existing conditions such as heart disease, etc., which have been biased towards male studies and seeing if we need to course correct so that they are actually applicable to more broader communities, including women, obviously. And then there's, like I said, when you're at different parts of your life, I'm really seeing a number of solutions blossoming that are dedicated to prenatal care, postnatal maternal care. Again, an area that's a bit of a blind spot. There are things you just don't talk about. There's things that you're lonely with when it comes to your pregnancy, your delivery, your recovery, and you're supposed to, society has decided, be left to your own devices on that. And here come these women and founders, non-binary men, everybody coming together and saying, no, we're no longer willing to push this under the rug. So I love seeing that cluster of technologies develop as well. I'd like to argue that the future of energy, how we compute, how we live and use AI are also women's issues. So I'm very happy to see founders in that space. Recently invested in a company that does neuroorganoids that I talked to you about. We have a bottleneck when it comes to drugs that help with depression, ADHD, Alzheimer's, simply because we can barely get it to work in mice. And if we get it to work in mice, it has a higher failure rate, much higher than any other drug. And so there's almost a standstill when it comes to those kinds of drugs. And so this team has developed mini brains, essentially, and they're building an AI model to really get you more clinically relevant data. So I think the world is your oyster. Sorry, that sounded so cliched in the world. But I think there's a very wide range of companies. You can look at Hormona out there. They're doing hormonal tests. Leia, they're doing the post-maternal care. And then I really, really enjoy seeing women in or starting companies that don't necessarily cater specifically to what we would categorize as women's issues, but just by virtue of being there, being present, you tend to build differently and expand upon what already exists and create inclusivity that you didn't even know was required in these otherwise male-dominated fields. So we're seeing that even when it comes to things like hardware, energy, infrastructure. So quite a few.
I'm excited for what's coming up. The statistics about the low funding rate for women-owned companies is well known. With that sort of statistic in mind, where do you think is the most urgent need for funding for women-owned companies?
I think it's definitely in the early starting up stage, and especially if you're targeting problems that are either assumed to be solved, like we talked about, or not top of mind for the investors because it's not something they face every day. So just that initial pool of capital, getting your company up and running is really a blind spot because you're aware that you're solving a problem that is very urgent. It's a clear fit, but the investor community may not be aware of this because they simply are not experiencing it, and then they extrapolate that no one else is experiencing this, and they assume that what you're doing is a nice to have instead of a must have. So I think informed investors who have diverse perspectives and abundant capital, because you can maybe find a few people who'll come in and support your idea. But what you really need is sustainable investments to get you started. So that initial pool, whether it's grants, angel funding, very early stage VCs, although I do recommend that it's better to maybe look at incubators and accelerators before you go down that route. So I think there's a dearth of capital in a couple of critical phases. I think understanding just how to get started, that first check. And I think sometimes women are misdirected to VC. And I say this as a venture capitalist, too early. And this is because that's all you hear about. You're a startup, you get funded, you get VC. And what you're not seeing, what you're not hearing is that often the male-dominated companies, what they've been doing is they have a network, not intentionally perhaps built, but maybe it's just accessible to them because of the circles that they have and the relationships that they happen to have, is usually wealthy individuals who you've been in contact with and can come in as an angel investor. Sometimes it comes from the universities that they're at. So you have incubators that you can spend some time in. There are grants. There are all these other avenues of getting capital. And I think it's not necessarily a dearth of capital, but there is a lack of communication and information towards a population that is struggling to overcome a lot of other barriers just to arrive and get started. And you don't know what you don't know until you're there, right? That's one thing. I think we need to have more early stage especially angel syndicates that are out there spreading information, not exclusively to women, but definitely being intentional about including women when they're out and informing early stage founders about sources of capital. Same thing for grants and financing. And then I think it becomes harder as you start to scale up. There are a lot of really ridiculous stereotypes that still persist. And I always wondered whether they were accurate. I almost didn't want to believe it, because they're so outrageous when you hear things like women are too emotional, and you really think these must be these outlier opinions that someone is exaggerating because, come on, I've never really met anyone who would say something like that ridiculous to my face. And then you are in certain situations where you're hearing those things being explicitly sometimes and sometimes very roundabout way being expressed around whether this person is fit for leadership or whether they're right. And this is usually around when the company's starting to take off, when your presence has consequence and your presence then therefore replaces someone else's ability to have that spot in a leadership position. And often it can be a man. I mean, that's where the friction lies. It's not par for the course, but I do think it's hard to raise funds when your company has significant commercial traction, when you're showing a lot of potential now to maybe scale up. And then it's a very strict source of capital. You're asking usually for larger checks. You're looking for different kinds of deliverables. And so it can be harder to both find capital that feels like a right match, supportive in the right way, and also feel understood and not diminished and not have necessarily a reductive approach to it. Unfortunately, there have been situations where women who have been raising later stage capital, having to take tougher decisions, I think sometimes we are biased to assuming that, well, a company run by somebody else would be better, or we're not sure yet, we're not certain if you can do it. There's always this idea, again, of if they are nice, are they soft? If they're not nice, then we don't like them. And somehow that matters when you can see exactly those kinds of behaviors being exhibited by somebody else in a similar position with no consequences. So no, I do think the scrutiny is harder at later stage. I think the capital, therefore, may or may not be available to you. It's bizarre to me. I was in one meeting, I will never forget this. Again, walking into the meeting thinking, but how bad is this problem really? And there was a male VC in the audience. Pros to him, he was actually in a meeting to understand more about investing with women and female founders and in female-driven companies. So props to him for that. But he sat in this meeting and he raised his hand and he said, well, I've been in VC for, I think he said 20-something years, and I've never met a female founder. If I hadn't heard it with my own ears, I really thought it was a stereotype. I'm not trying to paint him in a bad light. I think it's incredible that he voiced it. He said what others are walking around thinking, and he was in the room. So again, credit to someone for being there, raising their hand and speaking what he thought was his reality. And the response back from the team was, well, that's all we see. All we are investing in is women. They're out there, right? And there's a number of reasons here. If he's that biased, in 20 years, he's been convinced that the only reason he hasn't invested in women founders is because none exist. Because he's never met them and he's out all the time and he's talking to so many founders and they're always guys, and he's not realizing that he's confirming his own bias in that statement. So there is a challenge. There's clearly a challenge, even for those who are willing. And so it doesn't have to come from malintent. It doesn't have to come from outright sexism where you are trying to put the other person down. It's just so ingrained that certain areas are for certain people. You know, the VC is convinced that founders are all male. I don't want to call you out, but you started your own description as technologically wary. So we give ourselves these categories and we don't even realize that we're creating these rifts, and it comes down to capital as well. So you have all these VC funds that say, oh, okay, we are totally open to investing in women, and then don't, because they're convinced that they're trying, and they don't have the relationships, they don't have the intentionality, and they haven't made those systematic changes that they need to do to actually source deals from founders other than what they are currently doing.
If you had one piece of advice for women founders who are raising money, what would that be? Actually, let me caveat that, because I'm always trying to be practical in our conversations and always be able to, for people to take away actionable steps. However, I want to also caveat that the way I'm phrasing this question sounds like the women are the problem.
Yeah, I was going to say.
And I do not mean that. There's a lot of structural biases and structural things going on. But putting those aside, what can women do?
I'm so glad you said that, because I react to, there feels like there's often a burden on those affected by the problem to also find a solution for said problem. And I think it's none of your business whether society can figure it out or not. What you need are the tools to help you navigate it, whether it does or doesn't, in the time that you need it to. I think if you want to contribute to it, you can. But your job as a founder is not to make the statistics better. Your job as a founder is to succeed. But given the context, as you say, given that it's now well documented that there is a clear gap, and that gap exists for a number of reasons, not just what you said about the structural aspects, but also because of the size of the rounds that are coming up from entirely male-founded companies or mixed companies, are often very big, very bold products that are absorbing an enormous amount of capital. So when you look at, even if women were to go out and say, okay, well, we've started up 500 smaller companies, the amount of capital would still be a percentage point. So again, don't let these statistics wear you down. They exist, they are meaningful, but there's always a variety of reasons, and your job is to say, okay, so clearly there's a struggle ahead of me, something that I may experience or may not experience, but it's clearly not rigged in my favor. But that's okay, because I'm an entrepreneur and I'm building something that is entirely new, so I'm comfortable with my risks. I think what's important for female founders is to, one, decide, because you know that you have a bit of an uphill climb, perhaps a little bit steeper than some of the other founders, is to be very deliberate about what capital, how much, when you need it. Again, I think there is an overly broad recommendation to go to VC if you have a startup. Really question yourself. You're building a business, great. What is it that you need right now? Do you need some capital to get started? Great. Look around for grants, look around for smaller investors, look at bank loans, small business loans. Ask yourself what your growth plan is. If right now what you want to do is just start putting something together and seeing if you can take it out to market, that's not a VC case. You know that now. But maybe you have gotten to a point where you're saying, no, I've done all that. Now I'm getting ready to really ramp up. I want to build a team. And again, you have a choice. You can build a business off of saying, well, I'm going to find a little bit more investment so that I can grow it organically through customers. And that is perfectly respectable. Don't let anyone tell you that that's a worse business. There are enormous businesses that have been successfully built without a cent of VC capital. Minecraft never took a dime from VC. No one's going to look at it twice and say, well, that was not successful. So again, don't compromise on what you need for capital when it comes to who you get it from. And I think that's my advice to female founders. Be very intentional about what you want in terms of the amount and what you're willing to exchange for it. I think it's cheaper to pay interest on a loan than is to give equity on your cap table. So the last resort should be equity on your cap table. And if you have that in mind, that's the only thing. I think they don't need mentors. I think if anything, they might need nudges and help opening doors, sure. But it's really being as well informed as you can about the different sources of capital before you start the company, when you start the company, when you grow the company. That's my advice.
Wonderful. Thank you. If you had to summarize 3 tips on successfully angel investing in startups, what would those be?
I think you can definitely start to immerse yourself in the startup world before you invest. So go out and look at different companies, see what resonates. We talked about resonance, and they could be very different things. It could be something that is very close to you or something that you've never considered yourself investing in, but just for some reason it piques your curiosity. If it's something you're very comfortable investing in, then my tip is to go meet several founders and several teams and get to understand before you decide where you're going to invest in. And always, second tip, be able to invest more than once. You're not a good investor if all you can do is write that first check, right? Being an angel investor means being able to come in, support the company, whether it's through your time, through your capital. So you need to allocate and be prepared to do that. And the third tip is take a chance in investing in things that are very different from what you tend to go into, and through that you can use angel syndications so that you're not alone. You're not taking all of the risk. Maybe it's not your area of expertise, but you'd like to get involved. So there's, for example, we talked about a lot of life science cases, and that might feel very remote for people, but they can identify that they want to help with new therapeutics. So there are life science investment networks here in Sweden. There's several of them that you can be a part of. And so your capital is pooled, and therefore you also are able to support companies better. Take your time finding many different teams before you invest. Be prepared and have a plan for following up with your time or with your capital, and also find angel syndications to invest in.
But angel investing is notoriously risky.
Yeah.
You know, you will lose the money in some of the deals. It's mathematically impossible to not to. So how do you train your mind to accept that level of risk when investing?
I think you lean into it. You do not try to fight that fear. That fear is healthy. It's there for a reason. Like anything, you have to embrace it, and you have to understand that you are there to invest because it's high risk, high reward. And if that doesn't feel comfortable to you, then think about other stages of investing that are less risky, perhaps less reward, but that's the trade-off that you're willing to do. That said, I don't think anyone should only angel invest. I think it's really important, if you were trying to feed yourself off of the crops you grew, you wouldn't plant one seed and you wouldn't plant one crop. You need a varied diet. Same thing with your financial independence. You need to be able to do very high risk and maybe a lot of smaller high risk investments, and balance that with more stable, slower return investments, things like funds and bonds and things like that. And I think that de-risking is how you can sleep at night, not because that specific investment has to go well, but because your strategy is broader and you've de-risked as much as you can, both pre-investing. Again, you've taken the time to meet them, you've done your due diligence, you've taken references, you've dug into what you don't know, you've asked experts for help with what you don't understand. So you've de-risked as much as you can and put a plan in place for maybe the team. Hopefully you have a good coaching relationship so you can make recommendations so that you know you can help steer them and they will ask you for help. That's a form of de-risking and portfolio management, so to speak, which you can't do for bonds and other things. But then after that, you've just got to let it fly. And you really have to spread it out intentionally and understand your appetite for risk and take for granted that at least a third of your investments need permission to fail. Otherwise, also, again, you're a bad investor. If you're there and micromanaging their business because you're paranoid that your investment is going to go down the drain, you're the most toxic investor on the cap table. So again, find the balance of embracing the risk. You'll never be without it, but also working to make sure the individual investment is de-risked to the best possible way through your time or through the team, and that your portfolio isn't a single domino that can tip everything.
So we are out of time, unfortunately. The time flew by. Thank you so much for joining us and sharing all your deep insights into venture capital, deep tech, angel investing. I really enjoyed this conversation, and I want to thank everybody for listening to the Investing and Other Stories podcast.
Thank you so much for having me.
If you enjoyed this content, please take a moment to leave a rating for the Investing and Other Stories podcast on Spotify or Apple or wherever you get your podcasts. You can follow me, Margarita Tr, on LinkedIn or at Finance Latte on Instagram, and you can follow Mala Valroy on LinkedIn. Thank you so much, and see you next time. Cheers. The information provided on this podcast is for informational purposes only and should not be considered investment advice. The opinions expressed on this podcast are as of the day of the recording and are subject to change without notice. The views and opinions of guests on this podcast are not necessarily those of Finance Latte AB or its host Margarita Tr, collectively referred to as Finance Latte. Finance Latte is not affiliated with its guests or their affiliates unless otherwise stated. Finance Latte does not guarantee the accuracy or the completeness of the data presented herein. The information on this podcast is for informational purposes only, and the information, data, analysis, and opinions it includes should not be considered investment advice or tax advice, and is therefore not an offer to buy or sell a security. Finance Latte AB is not responsible for damages or other losses resulting from or related to the information, data, analysis, or opinions in the recording. Past performance does not guarantee future results. All investments are subject to investment risk, including loss of principal. Individuals should consider their own unique needs and circumstances and objectives before making investment decisions. Please consult with a tax or financial advisor for advice specific to your individual circumstances.